Things move fast in real estate, so let's see where experts are predicting that the market is heading. Hi everyone, Mike Tilford here with your Southern California real estate market update. It's been about 3 months since my last comprehensive analysis of the marketplace, so let's see how things have changed since then. Although there are a lot of indicators in the housing market that things are slowly getting better and there is a lot of positive sentiment among professionals in the real estate industry, we still have a long way to go until we are fully recovered. Before we get into housing, let's look back at how the economy is doing as a whole. After taking a huge hit back in April, employment numbers have been steadily increasing month to month, so people in California are beginning to return to work. We are also seeing an increase in consumer spending. If we factor out food and auto spending, which is still way down from what is normal, the remainder of consumer spending has already returned to pre-crisis levels. This is important because the economy is still roughly 70% consumer driven. When it comes to housing, interest rates are a huge factor, and they are very low. In fact, they are so low that in late July, we had a 30-year fixed mortgage rate that averaged less than 3% for the first time in recorded history. This, of course, is significant as lower rates reduce the burden on monthly mortgage payments. If you look at the monthly mortgage payment of the median priced home in California in June of this year, the monthly payment on that home is around $2,160 per month. Compare that to the median priced home in 2018, when interest rates were near 5% and the monthly payment is $2,460. This difference represents over $100,000 over the life of the 30-year loan. Remember, the median priced home in 2018 was lower than it is today, as prices have been increasing in most areas year after year. Basically, you're paying less money for a more expensive home. This is a huge incentive for buyers in today's market. California had a very robust bounce back according to our June data. On a month-to-month basis, sales in California were up 42%, which leaves us just 12.8% behind where we were at this point last year. Compare this to as recently as May, when we were down more than 40% from 2019. We've also set a new all-time high median price in June, reaching $626,170, which is a 2.5% increase from last year. As sales bounce back so quickly, we have dipped down below a 3-month inventory, with the median days on market being only 19 days. Pending sales from June were also up. Not only have the numbers recovered from May, but they're also ahead of the 2019 numbers. Consumers are really responding to the low interest rates. We're currently looking at more than a 20% increase in new mortgage purchase applications than we had at this time in 2019. Even with everything going on, demand is still very high. If we look at realtor sentiment, we can see that across the board, agents are feeling optimistic about the future. Many believe that there will be more listings, more sales, and higher prices. Despite all the optimism, we can see that the lack of available housing inventory has really affected our current recovery. If you look at the statewide data from June, active listings are down almost 44% from last year. As we can see, the upward trajectory of the recovery is not being limited by buyer demand, but rather a lack of sellers. Looking at the average new listings, we can see that we really haven't had much of an increase in daily new listings going all the way back to May. As a result, after hitting a peak around June 20th, there has been a flattening of average daily pending sales. And if we look at closed sales, we had our first weekly decline on the week ending on July 25th. We had a pretty consistent uptrend since around May, but like I said, the lack of listings is really slowing the growth. Even with the optimistic outlook of those in the real estate industry, there is still a lot of uncertainty due to COVID-19. As we can see, cases in California have continued to grow, as do the average daily deaths. This is going to increase uncertainty. Also, as a result, a clampdown on business activity, which is going to prevent us from getting back on stable footing. In addition, we see that the US GDP contracted almost 33% in the second quarter, which is the largest single quarter decline in recorded history. And even though things are moving in the right direction, we have a lot of ground to make up. We can see this in the labor market numbers. Although we have added back about 7.5 million jobs nationwide, we still remain about 15 million jobs below our pre-crisis levels. The job gains is huge progress, but it's only about 1/3 of the way back to normal. Even more ominous, in the US we saw jobless claims steadily declining week after week from the original surge in late March. However, as of the middle of July, jobless claims have again begun to rise. In California, we saw the rise in unemployment claims begin even earlier, starting in the middle of May. And although we have made significant progress from late March, we are seeing these critical indicators continue to move in the wrong direction. We are also seeing similar signs on the consumer confidence side of things. After 2 months of rebounding, in July, the index is again moving in the wrong direction. This makes sense as COVID starts to ramp back up nationwide. Job uncertainty is up, and that has taken a toll on consumer confidence, which again is critical as it represents around 70% of our economy. With the uncertainty in the marketplace, there is little surprise that we are also seeing more transactions falling out of escrow than in previous weeks. We have made a lot of progress and we are on the road to recovery, but that road has many twists, turns, and bumps along the way. Significant progress in the economy and housing market has been made over the past few months, but there's still a lot of uncertainty out there. We are not quite out of the woods yet, but things are getting better. Well, that's it for today. I wish I had better news for you, and if you found this video to be helpful, please like and comment below. Also be sure to hit that subscribe button so that you can stay up to date on what's happening locally in the community and in the real estate market. Okay, I'll see you next time. And as always, I'm never too busy for your referrals.